All right. Hello, everyone. Hope you're doing fine. My name is Łukasz, and I'm your host. Our presenter is Duke Wu, a head of consulting at Pragmatic Coders. Let us do a little housekeeping. The webinar will last 1 hour. In the first 50 minutes, Duke will present methods and insights about fundraising. The remaining 10 minutes are booked for Q&A. You are welcome to write questions related to fundraising in the chat. All the slides will be shared with you shortly after the webinar. The webinar is recorded. The clips will be available on Pragmatic Coders YouTube channel. Subscribe to get a notification. And now, without further ado, here is our guest speaker, Mr. Duke Wu.
All right. Hi, everyone. Thank you for taking the time to sit with me through that 1 hour where I'm going to talk about fundraising. So I'm Duke, and I'm part of Pragmatic Coders, and here I am. So some of you may know me from previous episodes of venture building. I've talked about sales. I talk about product market fit. So for you of you that are new to this webinar, I'm the head of consulting in Pragmatic Coders. Previously, I built an online marketplace for up-and-coming brands, which I raised $1.5 million, and we had more than $100,000 monthly of turnover. Then I moved on to set up two companies. One is Ryzen, the for people Python software development company, which is later acquired by NetGuru, and iMashUp, which is Google Docs for 3D, 3D collaboration platform for game development companies. So in my history, I've done a lot of fundraising. I have helped also other startups fundraise. So here I would like to tell you a bit of my experience on the fundraising process, and hope you like it. Right. So today I'm going to talk about some really basics of venture capital. You have to understand how investors think and what types of investors are out there. Then we're going to go deeper into what are kind of goals and strategies to fundraise, and then we move on to some really details about the execution, the tools, how to prepare for the meetings, and hopefully that some days you guys will also see the term sheets and investment agreement. And I'm going to talk about the tips and tricks to negotiate that investment agreement, some key terms, and how to successfully close an investment deal. At the end, I will show you my resources. During the time, please just ask questions, and at the end, Łukasz will read through the questions, and I'll try to answer every one of them. So here are the basics of venture capital. So you have two types of really people that have money that can or invest into your company. Those are VCs and angels. So the basic difference between them is that the angels are really people who have some kind of spare change that can really put the money into your business that they are not afraid to lose, and they are more into the thrill of a ride or the experience into building a business rather than making returns on a business. Those are people that are ready to lose all that money and to invest in you and to ride with you throughout the journey of building the venture. They can decide in weeks, and their checkbook is it's really small, but they can jump the bandwagon with other VCs if they see the deal as a good investment. On the other spectrum, we have VCs who are basically managers of the money that the limited partners put into their funds. So their whole goal is entirely different than those of angels. You have investment committees, the time is longer, and the investment strategy is defined, right? So no matter from who you're fundraising, it's crucial that you know what kind of type of investor that is. And the law of venture returns is really skewed. I mean, just a very small fraction of the funds actually make money from VC investing. So to put some numbers into that, perspective, is that less than 1.5% of the portfolio of the company, the portfolio companies, or less than 1.5% on average of every VC fund out there in the US will make 20x of their returns. So supposedly, if you have a $100 million fund, on average, you will make around $200 million of returns, and that's before even expenses and fees, which is typically 2.5% of the whole fund for the operations and for the the salaries of the managers. So it's pretty skewed, and as an entrepreneur, you will also spend a lot of time in fundraising. So on average, you will have more than 11 investor speech. Around 40% of you will pitch more than 11 investors, and it takes a lot of time and energy because that will involve you in the process of fundraising. That will involve more than 4 months. So make sure that you tell other co-founders or your employees is that essentially you're going to be taken out of running your business while fundraising, and it's important to remember that. So as investors, when you come to them and you have the first meeting, that's you as an entrepreneur, you are a single dot, right? They have no history of knowing how you performed early on, and they have no vision of how you're going to perform in a couple of months, a couple of weeks. So that's first a single dot into the series of meetings that you will have to build relationship with that investors. It is very hard to make a commitment to fund you as an entrepreneur right off the bat, right after the first meeting. So as an entrepreneur, it's the most important thing for you is to show how you're going to progress in the next months, the next weeks, or the next year. And it's important to stick to that plan and really show them what is your progress in terms of number of sales, number of revenue, number of employees, some technological innovation that you're going to make through that year. Some of the biggest fundraise that you have seen in recent days, they took at least 6 months to a year of relationship building. So the investor, from the moment that of your first meeting, they have to know how have you been doing throughout their journey. And the most important thing to do is to have them on the newsletter list, for example, and communicate them bi-weekly basis or a monthly basis about your progress. And that builds relationship, and that shows you the trajectory of how your investment, your venture grows over time. So build and nurture that relationship early on and show progress. And don't waste time on non-relevant investors. Keep the investors that are relevant in your newsletter, and update them pretty frequently about your progress and what are your plans into the future. So the key takeaways is that I really understand your target investor type and adapt. I'm going to tell about that more later on, and that understand that the fundraising process is a really time-consuming and energy-sucking process that gonna get pulled into. Typically 6 months, for more than 4 months, as a full-time job for the CEO to take on that, right? And I talked about earlier, build relationship with them, show some progress, and when fundraising, only build a relevant list of investors that you're gonna outreach. So let's talk about some general advice for goals and strategies. Do control the process and not be pulled into fundraising. What I mean by that is when you start fundraising, have a clear timeline when you want to close the funding, because during that time, there's going to be asymmetric information for all your investors. Once you pull everyone at the same in the parallel process. When you have many investors that are in the process of fundraising, They typically have less time to decide, and they do not have the feeling of how other investors going to react to that certain round. So that means that any piece of information investors get, has less time to spread through their network, and they have less time to make a decision on your company. So control the process, make the deadlines, and do not get involved with VCs that will promise you that they will come back in a month or two. Never do that. The good VCs, they will actually tell you about a week or 2 weeks if they're gonna invest or not. Other than that, it's a waste of time. No, your energy should be put elsewhere in the fundraising process. So number two, raise before you need the money. Raise when you have actually a long runway still until the end of your cash in your bank account. So number one reason is that when you are raising without a clear without hurry, is that you can create a higher valuation for yourself. That makes you have leverage in negotiations, and it create fear of missing out for investors who'd like to jump in. When you don't have the deadline, it's much easier to fundraise rather than when you know that in a month or two you're gonna go out of cash. The number two reason is that when you need the money most, it will push the risk of signing that investment agreement or that term sheet early on. So all the clauses that I'm going to talk later on, you will likely more accept, and it has huge consequences of both your personal and also your professional life, because those clauses, investment agreements, actually can ruin or make your life so much better, depending on the situation. So do raise before you need the money. And remember that fundraising is just as in sales, it's just a numbers game. The more relevant investors you talk to, the faster you raise, right? So talk with everyone that that will invest in a type of company that they invest. So an example is that you have typically in startups you have you raise for 18 the next 18 months. And depending on the stage of the funding, either you're going to angels round or pre-seed or seed or Series A, the dilution will typically come between 10% and 25%. Always start lower with a valuation. The demand and those big fundraise that you see on TechCrunch are typically because there's a huge demand for that round. The entrepreneur may have started lower, but because the startup is so hot, they're growing fast, and the entrepreneur has the skills to enforce the FOMO, the fear of missing out on all the investors, they are able to drive their valuations so much higher. So it affects, so the valuation is affected by the demand and really the round size of that fundraising. Avoid setting the price too early on. What I mean by price is the dilution of the percentage the investors gonna take you. In your pitch decks, never go out early or never even mention about how much you're raising for how much percent. I mean, you can typically lay out how much money you are raising, but it's better to leave later on how much dilution you are willing to take, right? So let's say that the goal is I want to raise $500,000 of equity and debt by Q3 2020, and that's my goal. You should set that very clearly in order for your team and your employees and your co-founders to know that you're going to be essentially shut down for 6 months, during that Q3 of 2020. So do consider if you're going to raise from angels or VCs. And to take the money from journalists or specialists. there are funds out there who invest only in IoT, in AI, in VR and AR. Relevant investors mean that they're gonna invest in your industry. They have their geographical focus, and their investment thesis is really aligning with what you are doing with your startup. Location is very important. Most of the Silicon Valley VCs, they won't invest in your startup if you are not in a driving range of, say, 50, 100 miles from where they go to the office. Essentially, if you raise less than $10 million, it's better to focus on your country or your surrounding countries than to go into US and raise money there, because one, that's going to take a long time to actually establish your relationship, your network. If you don't have anyone in your network that has been raising before in the United States, it's so much harder to go out there out of the blue to raise that kind of money. And second is that really the ecosystem or startup ecosystem in Europe or Asia or elsewhere other than Silicon Valley is really ripe. So it's not that harder to fundraise anymore than 10 years ago, where 1 million euros was something. Now it's like a common round for seed stage companies. When to actively fundraising, that's the goal to bear in mind. And have all in all, have a clear fundraising goal and strategy, but do adapt, along the way. So let's talk about some execution strategies that is going to be useful in fundraising. So it's really simple as in the sales process, right? You get a bunch of investors, you research them through Crunchbase or AngelList or Techstars, open database, which I can send you later on, or it's in a blog post on our website. Build a list like that and process them, and close the deal. Easy, right? End of presentation. But actually, there are a lot more intricacies in that. So step number one, identify the right investors, and that's what I can't stress enough is that don't waste time on investors that are not investing in that won't invest in your company. So look at the geo, the stage, the amounts, the market, the industry, and what's their investment thesis. They may invest in of your expertise, and look at what they do, what they actually do. I mean, not just what they say they do. Look at the portfolios, look at Crunchbase, look at all the news outlets out there, and to see what they actually invest in, and check if they're investing right now. So some of the funds may be fully deployed. So it's a waste of your time if all of their money is gone in the bank account, if they already are invested out in all of the startups in the portfolio. Remember to always do research also with the founders that were funded by them. So I have a lot of experience with Polish VCs who basically are financial managers who have actually no insight onto how to run a company or how to run a startup, to that matter. But actually are just financial managers, and it's it's a dumb money for them to invest in your company. When you actually at the very early stage of your company, you are actually looking for smart money, which means they can introduce you to later stage investors. That's number one. And the number two is that they actually have the back office, people in their team of marketers, of salesmen, marketing and consulting strategies to actually help you in the very early journey of your business. So step number two, you get them into the pipeline, and you build the right tools to bring them from the top of the funnel to the end of the tunnel. Make sure that you get best possible introduction to each investor. Choose 5 advisors or founders or people that are in your LinkedIn network, for example, or have mutual connections with that investor that you're gonna fundraise from, and get a warm introduction for them. But be prepared with the tools. The tools I'm gonna talk about later on. What are the tools for that introduction to be more effective? Always explain why you want to connect with a particular person. Now, as I said before, the good VCs, they will tell you in a week or two about a yes or no. So try to qualify or disqualify as quickly as possible, and try to move them through the pipeline as quickly as possible. Imagine that you have hundreds of VCs down along the list. You want to qualify them as quickly as possible and manage the same way that you'd manage your sales pipeline, right? Only talk with relevant prospects, qualified leads. So the key takeaway is that identify the right investors, get introduction to them, and move them through the pipeline. So here's an example of my pipeline that I've used in my previous company, iMeshop. If you want, I can email that template to you. You can use whatever information you have right here. So I have 3 tabs. One is the fundraising master tab, which lists the whole universe of VCs in Europe and in the US. And then I move relevant investor to this second tab, which invests in, so iMeshop was a 3D collaboration platform for gaming companies. So at the second stage, I chose the VCs or investors or the angels that invested are investing in software as a service companies, or in 3D companies, or tools for 3D, like game enablement tools, which iMeshop was. And that's the second tab. And the third tab, I have investors that I could actually get introductions to through LinkedIn, right? So let's talk about tools right now. In my presentation, those are all the tools that I have used during my previous fundraisings. If you want to have some sample presentation, sample pipeline, just email me, and I'll be glad to send that over to you. So the easiest way to build a pipeline of investors is one you get from that public list, such as TechCrunch list, Crunchbase, Techstars. All those databases out there are investors, but you can also do it on your own, because those lists are actually often outdated. Go to LinkedIn Sales Navigator, just buy a premium plan and filter through all the VCs that are existing in Europe and the US. Use Scrub.io and just export those details about their emails, their website, their company name, their position in the company, and easily manage them. It's easier to manage when you get a CSV and then integrate that into your favorite CRM software, such as Salesforce, Pipedrive, or HubSpot. And then use the tools that are gonna fit the email exchange, which could be Mixmax or any other email, let's say, exchange tools out there to help you better prepare materials and to be more efficient and really measure all the open rate and the conversion rate with your investors. So the 3 basic tools that will move those investors through your pipeline is, number 1, a forwardable intro email. That's the stage of, I'd like to learn more about your company. After that, send a 5-slide deck, a teaser for the investor. And that's the stage that the investor will say, I think we should meet, right? The full deck is only useful when they will say that, shut up and take my fucking money. So the full deck is really at the end of that stage of interest. So a forwardable intro email reduces the work for the person making an intro. Those people are well connected, make their job easier by giving them a blurb that is going to be consistent with what you want to achieve with your startup. The message should be addressed to the final recipient. It should contain no more than 2 paragraphs about your startup. 1 sentence, 2 sentences about what you're doing and why is it better than your competitor, and why is it relevant. I mean, the message of the email. Why is it relevant for that investor? And always, finish with a CTA. Ask for a meeting, ask for feedback, ask for another introduction. Always give them on their plate what they will have to do with all that information that you have provided them with. So here's 2 examples of intro email. Let's get back to iMashUp example. So my email was, my name is Duke. I'm CEO of iMashUp, a collaboration platform that helps game designers to 10x design approval speed and reduces communication friction, right? And then there's a part about relevant statement. What kind of traction do we have right now? Some key functions, and some key investors or accelerators that now I have onboarded. Show some team experience, and at the end, can you make a time for a quick call, right? Another tool is a 5-slide deck, a teaser, which you will send after they will answer. All right, so tell me more about the company. Or that teaser will be easily, taken as an attachment and then easily forwarded to other team members in that VC fund. We started with a problem, then the solution, market, and traction, and team. So again, let's use the example of iMashUp. So the problem is that the 3D artists waste 3 hours per day to ask for feedback for their assets. By the way, you may use those titles in a more efficient way if you just lay out the core message into the title. So never name the title a problem, solution, market, and traction, and team. Just actually go straight to the point. Actually title your slide as I shown here. There's a problem, we have the solution. So our cloud collaboration tool streamlines communication between 3D artists and their clients. And that's the solution, answering that problem. And now what is the market we are chasing? We are addressing a $5 billion 3D collaboration market. The market is, if it's going to be the US investor, really they won't even look at markets which are less than $1 billion. Why would they invest in a company and have 20 of them in the portfolio if they are not sure that the market that you are after is growing and it's large enough for you to be a $1 billion company? So the traction, show that you have some users, you have revenue generated. The team has to be strong, and the VCs, they really have to like the team in order to invest in your company. So here's an example of the teaser for iMashUp. As I said before, just hit me up on email, and I can send that to you. At the end, if they have gone through the intro email, and if they have gone through the teaser, you can be pretty sure if you land the full deck on investors deck, they're ready to talk business. I mean, they're ready to offer you the term sheet and the investment agreement. So here's a basic structure of that full investor deck. You're gonna talk about the team. You're gonna talk about the vision, the problem, the demo, how the product looks like or how it works. What is the traction? Any traction. If you are a social networks, and how many daily active users you're gonna have, how much revenue, or monthly recurring revenue, or annual recurring revenue for your software as a service business. Marketing, sales. How do you plan to acquire those customers, and what is the cost of them? What is the lifetime value and cost of acquisition for each customer? You have to explain them the business model, how you're gonna make so that your software will make those clients reach their pocket, to transfer the money to you, and really what is the differentiation? what is your secret sauce? What is your competitive advantage over other companies that you are competing with? In software as a service business, it's called a moat, and it's really important that the more you grow, you create a bigger moat, like a defense wall before your competitors. So what's the opportunity? What I talk about, investors are really excited when they see a big market with a growing potential. And the funding, the key terms of funding: how much are you raising, for how much time? Do not, tell them upfront how much percent are you willing to give. The demand, the valuation will be largely driven by the demand in the current ground. A lot of people also add some financial models, other slides into the presentation. All of these can be easily added to appendix. Once the VC or investor can ask some questions, poke holes into your presentation.
Apologies, it seems that we have some technical difficulties on Duke's side. I hope he will resolve them quickly.
Right back online. Sorry for that. Technical problems. So yeah, I was talking that financial model or any other slide that is outside of this list should be put in appendix. Once they start asking questions, you will have your presentation ready. So key takeaway from this are, have a solid forwardable intro email, have a teaser, have a full investor deck, and a financial model, and use them at the right stage of fundraising. So let's imagine that you are in a full on a demo day in a room, full of investors and journalists. Guys are after a long day of meetings, and there are really a lot of them are really old people who, if they sit at the back, they can't hear much. And some of those journalists are just out of school, and they really don't understand a lot about technology and investing in startups. The key message here is that people that you're gonna present to most of the time are going to be either are falling asleep, or they're uninterested by, or they just get bored pretty quickly. So express your presentation and your idea in a simple way. Don't you use buzzwords, and don't use long sentences. I mean, the moment you are trying to put a lot of AI and VR and AR stuff into your presentation, that's the moment when they're gonna drift off in their dreams. And don't sell to your investor. I mean, the good investors, the good VCs, they will always try to internalize what you're saying. They don't have to be sold. They are actually people that have built businesses before, or they have exited businesses before. So they will internalize your your findings, your idea, and they will extrapolate that idea into their own vision, and they will think about how unlikely events will have to unfold before you reach that billion-dollar company, like unicorn status, right? So they are very good sellers themselves. So don't try to sell to your investors. Just be yourself, be genuine, and lay out really to the point explanation of your business. So the 3 text points for the VCs are really simple. One, do I understand that idea? In order for me to understand that idea, you have to be very clear and communicate in a simple way. So that's number 1. Number 2 is that am I excited by the idea, right? Is the market big enough, or is it growing? Or there's so many clients out there, customers out there with that same pain. and you are the one that will solve the problem. And number three is that, do I like the team? Is the team experience? Do you have the motivation? Um, will you, sacrifice your life and your personal life in the next 10 years in order for me to invest now, right? So just remember that, running your company that is going to be funded by VC is totally something different than, starting a company, bootstrap that, and have your own cash to invest and reinvest the profits in the company. That's totally different. If you are playing, the VC investment game, you have to be in it for another 10 years, because the first round you're going to do is probably a few years away, or likely 10 years away from your exit. So just be prepared to be on that journey. So make it legible. Express clearly your presentation. Your points. And as someone said, it has to be understood even by a distracted teenager. Your presentation should be understood even by a distracted teenager. So let's look at really simple elevator pitch from those companies. Airbnb is the first online marketplace that lets travelers book rooms with locals instead of hotels, right? In your whole sentence, you have the whole business model of that. You have the customers, who are the customers that will use the platform, and who are the competitors, and why is it better than competitors. Dropbox synchronizes files across you or your team's computers. Super simple, one sentence that easily can be understood by distracted teenagers or old people, investors in the demo day conference room. Lumini is building X-ray vision for soldiers and first responders. Very simple elevator pitch that if you don't understand yourself, or you don't understand your idea, who will? I mean, you are the one, you are the best guy to put that single sentence on your startup for other people to understand. Meeting tips number two, when you start your presentation, say that it will take 15-20 minutes. Typically aim for 30 minutes meeting. 15-20 minutes is the time when you will pull slide deck, and don't be pulled into those questions that investors going to ask. Don't lose flow. Stick to the script and answer 2-3 questions per slide. Don't get dragged into the whole discussion about what are your who are your competitors, or what is your competitive advantage. Just don't argue with them. Be precise, and share things that you don't know. It's okay that you don't know certain things. Come back to your team. Ask them. Come back later with your investor. You can always follow up after the meeting, and be honest and don't lie. I mean, once you put anything that is suspicious, they will pretty much discover that earlier or later on. Most of the VCs, they know each other. In Poland, especially in Silicon Valley, even more. They can just grab a phone and ask you a few things. So what are the questions to ask investors? Really be prepared that it's gonna take in process. So what are the next steps in the process, right? So know before what are next meetings they are planning, and what concerns do you have. It's investment. It's important to know, does the VC lead this round, or they will follow, and ask about how the VC, if they are good VCs, they will have the back office which will help you throughout your journey in building your company. Follow-on meetings, angels, they likely just want to get more info. If they will invite you for another meeting, it's going to be all about talking and get to know you better. If the VC or micro VC will invite you for another meeting, it's likely that they want to meet more people. They want you to meet their limited partner or their consulting partner. In that case, just present to them the same pitch. If you are not sure what's the purpose of the follow-on meeting, just ask. Don't ever show up to a meeting without knowing its purpose. Ask them. Be prepared for that meeting. So the key takeaways are these: always do your homework and be prepared. Be flexible, but don't lose flow or control of the meeting. Ask questions, ask for next steps, and do follow up after each meeting. To explain things that you don't know that that can be discussed later on. Right. So we have around 10 minutes left. That's perfect. Let's talk about some term sheets and investment agreement clauses. So here's the software as a service funding napkin made by Point 9 Capital, and that's to show you how what are the current terms in terms of software as a service businesses. So nowadays, when you have less than $200,000 of annual revenue, most probably you will fall anywhere between 4 and 11 millions of valuation, and the round size you are likely looking into is between $1 and $4 million. So at this seed stage, because I believe most of you are at the seed stage. At this stage, the most important thing is the product is loved by early adopters. The product market fit is the key milestone here when you are fundraising the seed run. The investors have to know that all those early adopters, they are likely coming back to you. They like the product. And if you have evidence that those early adopters are really using your product because it solves their pain point, you are in a sure zone of using that amount in that seed stage. So here's an interesting fact about dilution and how much percent should you raise for each stage. This data concerns Crunchbase data, and it says that from the seed stage to Series A, you are most likely to already lose around 50% of your shares, right? So at the angel stage, the median is that you lose 10%. At the next stage, pre-seed, the median companies, they lose 9%. At the seed stage, 10%, another 10% of the company. So now you have 30% of the company already taken, even before the Series A and so on. After Series A, when you fundraise, you will likely have to give a bump in terms of dilution to 20%. So that's going to be 50% overall after Series A that you will like control of your company. You and your co-founders will likely lose control of your company. This means that you will probably have board seat member, and you won't be the sole decision makers in the company anymore after Series A. And there are a lot of questions and why is that there's a huge bump in terms of dilution from seed stage and Series A. So from the seed stage to Series A, you are really jumping into the big league. You are talking with more serious investors who are typically people and funds who have large exits before, and now they know that there will be follow-on rounds. So they want to take as much control and as much shares as possible at this stage. Because if you are a successful company and you are already on the path to raise even more financing, then their shares gonna be diluted further on. So 20% is the sweet spot for them to invest in the company at stage at Series A. Remember to keep your cap table clean. What I mean by that is that when you are fundraising for Series A, if you have an investor who owns like 80% of the company already, then it's like 20% left for you and your co-founders and your employees in the company. It gives not much of that um, um, incentive to run the company anymore. So all the serious investors at the Series A really ask you, number one, to either clean up your cap table. I mean, reduce the controlling stake of that investor that you have fundraised through, angel, pre-seed, and seed stages. Or number two, they won't, invest in your company at all, because with all the timeline that is going to take from Series A to actual exit, it's going to take so many rounds and so much effort, that you as a founder and you and your team will have to be incentivized in order to run that company. So let's talk about some key terms here. But before that, let's look into the option pool right here. It's really important for you to set out option pool for your employees. Those are the key people who help you run the company. And if the Series A investor is going to look at your cap table and you have no option pool for your employees, that means just that your company is less investable, because in order for you to succeed, you will have to pool experienced managers, hardworking employees in your company with shares. And with that, you have to reserve an option pool, and the investors will always ask before investing that you reserve an option pool, typically 10%, 5 to 10% of your whole shareholder structure for your employees and future managers and key personnel in your company. Right. In terms of term sheets and really the basics of investment agreement, know what is pre and post money valuation. If you have a $1 million pre money valuation and the investor is going to invest $200,000, $500,000, for example, then the post money is going to be $1 million plus $500,000, which means the post money valuation is $1.5 million. And that would mean that $500,000 that the VC invested is going to take 30% of the company. Understand what is vetting and how your employees, the option pool will vet over time. You won't be giving shares to your core employees or your future managers instantly. You have to have that option pool, number one. Number two is that those shares will have to be vetted after some time, based on performance or based on the time being in that company. After a year or 2 years, gradually those shares will be vetted by your employees or managers. Very important thing is liquidation preference. How much money the investor will likely take when there will be an exit event, right? So they can either take the 1x of liquidation preference, meaning that if they invested $5 million into the company, the liquidation preference will say that at first you will have to repay them that for $5 million. And depending on other rights, they may require to sell the shares pro rata on the rest of the shares. The drag along, tag along are the causes which majority shareholder can have the right to take minority shareholders in an exit event. Tag along means that if there's a third-party buyer, can join in the sales process on a pro rata basis. Anti-dilution just means that whenever, let's say, a situation of your next fundraising round is where your round size is going to be less than the previous one, and your valuation will be less than the previous fundraising, because you're not selling that fast. I mean, you're not growing that fast. And number two is, the market is less favorable than in previous round, which is, I think, pretty much the situation we have now with the pandemic. The anti-dilution states that in that event, the shareholding structure for that investor will stay the same no matter how much shares you will issue in that fundraise. So the tips are in negotiating and in how you look at the term sheet and the investment agreement. Look at how broad the preemptive right is. Preemptive right and the right of first refusal are some basic key terms that you have to know. So they will state who is going to be the first who will acquire the shares after some kind of share issuance. If it's good, if it's going to be another investor, then they have the right to acquire those newly issued shares, and that will create conflicts inside that shareholding structure. The IP rights, keep everything on paper, keep the stock records. Don't be too soft on IT dilution and liquidation preference terms. Negotiate on the how much percent investors are going to be diluted in the next rounds or not. And what is the structure of the liquidation preference? What are the terms of how much and who will be the first in line to get that money from the investment? Don't give board seats too early. Control your company and protect yourself. What I mean by that is have a way for you as a founder, as a CEO and founder, to be able to pull out of the whole deal. What I mean by that is have a safe way for you to stand as an advisor, as a consultant, when your VCs will likely want to control you and give their managers into the board. You will have to have a way in order for you to stay as a consultant if you do not wish to be part of that company anymore. Just play it safe and really decide if you really want to spend 10 plus years in this startup with all the co-founders or alone and this VC setup, because that's going to be a long journey. So we have 5 minutes left. Here are the resources for all of my presentation. The full presentation will be sent to you after this this call. And if you want some example intro forwardable intro emails, the pitch decks, just write me an email, duke.view.huang@pragmaticoders.com. Thank you. I welcome your questions right now.
Thank you, Duke. Great presentation, excellent insights. There are already a couple of questions on the live chat. I think they relate to one of the slides with tips and tricks. So someone wrote, should that be vesting, not vetting? Yes, on that slide. Shouldn't that be vesting instead of vetting?
Investing, of course. I'm sorry.
Okay, so point for you, Aiden. And another question, do you mean literally on paper?
The IP rights.
Yes.
I have absolutely in my time, there were a lot of times where the investors had, the limited partners sometimes are public funds. That's in a lot of European VCs cases, that's commonplace, where they raise financing from from the European Union or from the government. So typically, when you have limited partners like that, you have to keep everything on paper. Yes.
I don't see any other questions in the chat, but we may have still a delay in between our conversation and the streaming on YouTube. So let's give a while. So everyone, please write your questions in the chat related to what you presented, and we will try to address them now. Otherwise, you can reach out to Duke and ask your question individually. So how is it? It's the last episode of the venture. Duke, how do you feel now? You've spent with us 3 sessions.
Yeah, I mean that's not enough. I mean, just those are just 3 sessions, but really there's so many intricacies in running your company and fundraising is that